Hey everyone, Happy New Year. It's officially 2026, and I want to walk you through just a few good to know money updates in this short video as we head into the new year. First up, retirement contribution limits. Every year, the IRS sets limits on how much you're allowed to put into retirement accounts. They do this because these retirement accounts come with tax benefits, and without these limits, well, people could then theoretically put unlimited money in these accounts and avoid a lot of taxes. Over time, the IRS raises these limits really to keep up with inflation. But in 2026, we did get some increases. If you contribute to a 401k or a 403b, you can now put up to $24,500, which is up from $23,500 in 2025. If you're age 50 or older, the IRS does let you put in extra money each year. This is called a catch-up contribution, and it basically gives you more room to save as retirement gets closer to, well, catch up. And for many years, there was just one catch up, and now we have two recently. A second larger catch up was added. And here's how it works. If you're 50 to 59 or 64 and older, you can put in an additional $8,000 into your 401k or 403b. If you're between the ages of 60 and 63, this is that second catch up or what's called a super catch up, and you can put in an additional $11,250. Both of these are above and beyond that $24,500 number. Now, you might be saying, Nick, that was Spanish. I'm sorry. This can get a little confusing. It's okay. I'm learning to explain things more simply, but there are just some things in finance where it's really hard. Now let's talk about IRAs and Roth IRAs, or individual retirement accounts. For 2026, you can contribute up to $7,500, which is up from $7,000 in 2025, so just a $500 increase. If you're age 50 or older, you also get a catch up for IRAs and Roth IRAs, and this is an $1,100 additional catch up contribution for a total of $8,600. I feel like every time I say catch up, I'm saying ketchup, like ketchup and mustard. It's just in my head now. One important reminder with Roth IRAs, there are income limits. For single filers, it's once adjusted gross income hits $153,000, and for married couples, it's $242,000. All this means is that once your adjusted gross income hits this number, the IRS starts to limit how much you can directly put into a Roth IRA. But there are still planning strategies available to add more Roth dollars depending on your situation. Next, HSAs or health savings accounts. If you have self-only coverage, you can put up to $4,400. And if you have family coverage, you can put up to $8,750. Now, you may have heard some buzz around Trump accounts, especially if you have young kids. At a high level, yes, the $1,000 government contribution is real. This applies to children born between January 1st, 2025 and December 31st, 2028, and a parent or guardian must enroll the child. The official rollout is expected later this year, I think around July, and there is a website which is right here on the screen if you want to find more information on them. This is also where you will set up the account. For now, this is mostly an awareness item, not something most families need to go rush and do. We'll, of course, keep our tabs on it. And finally, a quick tax update, of course. The standard deduction was increased for 2026. For married couples, the standard deduction is now $32,200. Single filers, it's $16,100. Now, there are new deductions, temporary deductions, and I say temporary because these deductions were part of the One Big Beautiful Bill Act, and they're set to expire eventually. And this is for tip deductions, overtime pay deductions. There is a new senior deduction, $6,000 for single filers and $12,000 for married filing jointly. I'm not going to go too deep here. Talk to your CPA, see if these matter for you. But other than that, there you have it. I know, invigorating stuff. If you ever want help connecting these updates, these rules to your real life, well, that's exactly what we do. Happy New Year. I'll see you soon.